Hi, everyone, and thank you so much for joining us for week 2 of BFSG's 4-part summer webinar series. Today, covering women and wealth. With that, let me pass it over to introductions. Tina.
Hello, everyone. My name is Tina Shackman, and I'm a senior retirement plan consultant with Benefit Financial Services Group. I work with the employers to help manage and oversee the retirement plan, and I also provide educational services to employees.
Great, thanks, Tina. Again, my name is Keith Johnson. I am a senior education specialist and financial planner with BFSG. So essentially, my role is to help folks plan for retirement, investment management, as well as general financial planning guidance. So thank you all for attending. Really appreciate it and hope you get something out of this session.
So today's webinar is designed to provide wealth building tips for women. As we see many unique challenges when it comes to saving for retirement. And the first, and probably the most significant, is women are still earning less than men. It gets even lower for women of color. And this can be one of the biggest obstacles in reaching our retirement goals. Another area that reduces the amount women earn during their working years is women are still primary caregivers. In fact, 14% of women in their prime working years between the ages of 25 and 54 don't work because they're full-time caregivers, compared to 1.5% of men in that same age group. And a recent analysis done by the Century Foundation found that 50% of women, 50% of mothers do not have any retirement savings, compared to 1/3 of fathers. One of the major concerns that we do hear from people near and in retirement is outliving their money. And this is specifically important for women as they have historically had longer lifespans than men. Social Security data shows for a couple that reaches the age of 65, 1/3 of men will outlive their wives, while 2/3 of women will outlive their husbands. One of the more positive trends that we've seen is that more and more women have entered the workforce and are starting their own businesses. 49% of women are now the breadwinners in their household, and that number is expected to grow. I'm the primary breadwinner in my family, and my biggest challenge is trying to get my husband interested in the household finances. And believe me, it's a real challenge. This is a guy that struggles with using an ATM. So I've spent a lot of time getting things properly documented, and that's something that Keith is going to talk about a little bit later. Also, women-owned firms now account for 39% of all privately held firms, and there are over 11 million women-owned businesses in the U.S., generating nearly 1.7 trillion in revenue. And statistics show that women are expected to control over 50% of the wealth in this country by 2030. So it's more important than ever for women to have the resources and knowledge to maintain and grow their wealth. The last challenge was a bit surprising to me. Women hold more debt in almost every category, with the biggest disparity between men and women being student debt. And that's because women typically need more education to earn a wage equal to a less educated man. And according to the American Association of University Women, most women will face a gendered wage gap as soon as they graduate, and it can worsen over time. So let's take a closer look at some of these challenges. A recent study by the TIAA Institute shows the disparity in wages for men and women. In 2022, women earned 83 cents for every dollar a man earns, which is up from 60 cents in the 1970s. So there has been some progress, but that has not been the case for women of color who are still earning around that same amount. Based on data from the Bureau of Labor Statistics, it shows that even the higher educated women still face wage gaps, and that gap is larger for older women than it is for younger women. And another hurdle for women is that you'll see more women than men working part-time. And they may not have access to a workplace savings program like a 401k. So that can also be another obstacle. As I mentioned earlier, outliving your money is a major concern for retirees. Statistics have shown that women are expected to live longer than men. Over 20 years, women could expect to live 4 years longer than men, but we've seen that differential decline slightly. It's about 2.6 years in 2021. Based on data from the Social Security Administration Office, if you are a 65-year-old woman today, you would have a 57% chance of living to age 85. And that number jumps to 72% if you're a non-smoker in excellent health. Therefore, the majority of women will need to plan for at least 20 years in retirement if they retire at the age of 65. But we are starting to see trends of women working past 65. A 2019 study by Transamerica found that 55% of women expect to retire after age 65 or do not plan to retire at all. And because women are living longer, they'll spend more years in retirement with potentially fewer assets, which may lead to more women living below the poverty line. According to a recent US Census report, women age 65 and older are about 43% more likely than men to live on an income below the poverty level. That's why we always say to start saving early and often, because nobody is ever disappointed to learn that they've saved too much money.
I agree with that one.
And the last challenge is the fact women are living with higher debt levels. Since as I mentioned earlier, women have more debt than men in almost every category, with credit card debt being the largest. What we've seen with retirement savers is they may stop saving or reduce their savings rates to pay off their debt. So this can be a double whammy against reaching retirement goals. And it's particularly prevalent when someone is carrying higher levels of debt, student debt. And today, 2/3 of US student debt is owned by women. So now that we have a better understanding of what the challenges are that we face, let's talk about some ways to overcome these obstacles. It's important to understand what we can control and what we can't control. There's many components to a sound retirement plan, but there are only a couple that are within our control. What we can control is how we invest and diversify our assets and how much we can save and spend. Areas that are out of our control are how the markets perform, government policies around how much taxes we pay, how much we can save in tax-deferred vehicles like an IRA or a 401k plan. And what we do have some control over is how long we work and how much we earn during our working years, and potentially how long we're going to live based on how well we take care of ourselves.
And I think Tina here really quickly, investor behavior is driven so much by emotion. You know, we get caught up in the stuff we can't control. You see the news report of the day. How can you not, succumb to making decisions based on that? But it's really about taking the long-term perspective, diversifying your portfolio. Tina will talk about that. Saving early is huge because for a lot of folks, you could actually be spending more years in retirement than working. That's where we are right now. So it's really important to focus on what we can control. That will help get you to your long-term goals.
Absolutely. And when we talked about that, what we control, how we can invest and diversify our assets, it can be tricky. So when you look at this chart, there's a lot of colors and numbers on here. And what it's reflecting is the performance of major asset classes, such as large cap stocks. Think of Meta and Amazon and Google, bonds and real estate going back 15 years. And they're ranked by the top performer to the worst. So you'll notice that no one asset class will stay at the top for very long. And sometimes the top performer one year will be the worst performer the next. For example, in 2017, kind of in the middle of the chart, emerging markets happened to be the best performing asset class. But the next year, it went from first to worst. So no one can say which asset class will be the number one performer next year, which is why it's important to remember that market returns are definitely out of our control. So what can we do? Well, when we look at the white boxes in the middle, they represent a balanced portfolio, which is designed to smooth out returns year over year. So while you may not have the highest performance that year, a diversified portfolio can at least help you with riding out those ups and downs of the market so you can stay invested. And that's important because more than 90% of your overall returns are the result of simply having a diversified portfolio.
And I think here too, Tina, but prior to everything that was going on with COVID and everything, the market's been extremely volatile. Prior to that, we were in the midst of one of the longest bull runs in the history of the stock market. So risk, it really didn't matter because everyone felt like, hey, things are going to continue to go up and up and up. Over the long term, they do, but this volatility is normal. It's part of the stock market cycle. And to Tina's point, the asset allocation models, it helps mitigate some of those peaks and valleys because no one wants to be on that roller coaster ride. So it's a great point, Tina.
Yep. Well, and let's have Chad launch the next poll. We'll see how everyone feels about market volatility.
I like it. Thank you guys. So for everybody on the line, if you are on the computer, not on a phone, I did just launch a poll. It should pop up on your screen. Please, this is interactive webinar today. We have one more poll coming up later today as well. The poll is, if the market were to fall 20% in 1 year, what would you do? Right? Yikes, sell everything, do nothing, just wait it out, maybe buy more stock, right? Market's down, buy low, sell high, or I have no idea. Please let us know your thoughts. I'll leave this up for about 15 or 20 more seconds before I close the poll, and I will share results with the group.
And Tina, while we're waiting on this, when was the last time the markets actually did fall 20%?
Well, it wasn't that long ago. It was actually last year in 2022. The US equity markets, which is measured by the S&P 500 index, fell as much as 30% during the year and finished the year down almost 20%. So we just went through this.
Hey guys, so I just ended the poll. Great commentary. What we have right now is no one, literally 0% said, yikes, I'll sell everything. That is amazing. That means we have awesome participants and awesome attendees on our webinar. Great decisions. Most people, 63% say do nothing. I'll wait it out, which is fantastic. That's exactly what you're supposed to do. 26% said I'm going to buy more, even better, right? Because we know it's going to come back by a low, so high. And 12% said I have no idea. Maybe this webinar will help them.
Well, it is. And it doesn't actually surprise me. If we're on the next slide here, there we go. It doesn't really surprise me because women definitely take a different approach to investing. And based on a recent Schwab study, it does show that women really see investing as more of a life skill, while most men see it as a competition. Women will focus on not losing money and tend to look at whether they're achieving their long-term goals rather than just looking at performance. In a 2021 survey, Wells Fargo found that women tend to have more of a disciplined approach to investing. And while they tend to be more risk aware than men, it didn't translate into lower returns. And that's because women tend to be more patient when making investment decisions and do the homework, while men tend to be a little more overconfident, and it can lead to excessive trading. So the good news here is women are more likely to invest in an appropriate asset allocation mix or investment mix and not take on unnecessary risks. So Keith, I guess my question to you would be, you've worked with many women over the years. Would you say that these characteristics hold true with your experience?
I would actually, in doing this for 27 years, I would agree with these characteristics and that they do hold true. I will conduct hundreds of financial planning appointments for married couples every single year, and literally more times than not, couples, they always assume that their risk tolerance is the same as the spouse or the partner, and that's just not the case. So it's really important when we go through this, if someone partner's risk averse and then another one's aggressive, to construct a portfolio, looking at everything holistically so it's not too conservative, it's not too aggressive, but something that will help achieve long-term goals. And these are some really important considerations here. So yes, Tina, I agree 100%.
Yeah, that's an interesting perspective. I hadn't really thought about having the different risk tolerance and how you figure out how to blend that. So that's interesting. Well, staying on areas that we can control, once you do have that diversified portfolio built, the next step is really making sure that you stay invested, as Keith mentioned earlier. Investing isn't a marathon, or is a marathon, it's not a sprint. So if we want to look back 50 years, we can see the markets have crashed 9 times over the last 50 years. And during that time period, if you had invested at the peak of the market, you still would have made money every single time, assuming that you stayed invested. Behavioral economists have demonstrated that losses hurt more than gains feel good. Natural reaction after a particularly bad day in the market is that you want to sell and reinvest once the volatility subsides, whenever that may be. The result of trying to take control by selling is typically to lock in losses and miss some of the best days in the market that follow. The chart on the screen here compares the performance of $10,000 that was fully invested for 20 years and earned 9.8%. If 10 of the best days are missed, that return is cut almost in half to 5.6. And if the 30 best days are missed, your returns are practically wiped out. So how likely is it to miss these best days? Very likely. In fact, 7 of the best 10 days occurred within 2 weeks of the worst days. So it's really would be difficult to time the market. And it is important to stay focused on what we can control. So investing in an appropriate mix of investments that align with your risk tolerance, and then staying invested for the long term. It's really the best strategy. And I'm going to turn it over to Keith to talk more about some retirement planning techniques. But first, Chad, I think we're ready to launch the next poll question.
I love it. All right, group. So I mentioned we would have our second of only 2 polls today, but interactive poll. We're talking Social Security. When do you plan to take it? This is really meant to give Tina and Keith the gauge on the audience. We're going to talk Social Security. We had a big webinar last week on this same topic. But again, you have 62, 65, your full retirement age, which could be age 66 or 67, depending on your date of birth, or wait till age 70, or I have no idea. These guys will tell you, do not wait till after 70. You get no extra benefit by waiting till 75. But again, I'll leave this up for about 10 more seconds and we'll close poll and share results. Okay, let me close polling and I will share the results with the group real quick. So again, we got about 9% saying 62, another 9% saying 65, about 40% saying full retirement age, which I think is pretty standard out there. And 17% saying age 70 and 25% of the group saying I have no idea. So can we enlighten?
So this is an interesting one. The majority in reading articles about Social Security, the goal or objective for a lot of pre-retirees is to take it at full retirement age. The reality is almost 50% of retirements, they weren't anticipated, whether it's a medical or employers changing the dynamic. So there are a lot of considerations. We're going to drill down on Social Security here and talk about that, because once you do this, you apply for benefits. It's an irrevocable decision for all intents and purposes. And Social Security, this is a key part of refining your overall financial plan. So obviously making an informed decision about when to claim is really important, especially for women. Longevity, you have a longer lifespan, or maybe you're married and there could potentially be a survivor benefit in the future. So there are a lot of moving parts here. So generally speaking, the earliest you can apply for benefits is age 62. And again, we look at this, in fact, more than 1/3 of women take their benefit at this age. In doing this, your benefit is actually reduced by 8% per year until you reach your full retirement age. And then on the flip side of that equation, if you delay benefits to age 70, your benefit will actually increase from your full retirement age until you turn age 70 by 8% year in, year out. So you'll also notice on the slide that more than 1/3 of women expect Social Security to be their primary income source. This again is a really complex topic. We always recommend you should reach out to your trusted financial advisor for guidance. If you don't work with an advisor, we have quite a few resources here to kind of guide you and coach you along the way when it comes to Social Security. And towards the end of the presentation, we'll provide some contact info if you're interested in exploring this a little bit more. So when we do talk about Social Security on average, women receive a lower Social Security benefit. Tina talked about this earlier on with the income. But what's really important to understand here is Social Security is totally neutral with respect to gender. So they'll look at individuals with identical earnings and histories, work records. They're treated the same in terms of benefits because that's what drives Social Security is the income. And like I said, Tina talked about this a little earlier. That's why we're seeing this gap. So either way, when you look at the slide, you'll see from 2012 to 2020, the percentage gap between benefits has actually declined However, the actual dollar amount difference has increased. Okay, so right now, this is a hot button, healthcare costs and inflation and things like that. Right now, it's estimated that about 70% of the wealth in this country is controlled by the baby boomers. So their number one fear as they enter and transition into retirement, what do you think that is? Running out of money. And this slide right here, rising healthcare costs, that's a big reason why. So estimated annual out-of-pocket expenses per person for healthcare in 2023 is projected to be around $6,200 per year. And then if we fast forward way into retirement, estimated future value, total average monthly cost for a 95-year-old is close to $3,000 per month. The scary thing here is this doesn't even account for potential long-term care expenses in retirement. So that's why it's so important to account for these expenses when you're going through your financial plan and looking at everything, just to uncover all those pitfalls and blind spots. So this chart in particular here shows average estimated healthcare costs for one non-smoking individual at age 65. They have the original Medicare and all the original parts of Medicare, including Part D for prescriptions, dental, vision, everything that comes along with that, hearing devices. When we look at supplemental policies, so supplemental policies are also called Medigap policies because they fill in some of the gaps in Medicare, such as Part A and B, copays, deductibles, things like that. Talking a little bit more about the cost. So the median estimated cost in 2022 for a 65-year-old enrolling in Medicare, it's about $500 per month, or around $6,000 per year. So for the average person, healthcare costs are projected to nearly triple in the next 35 years. So there are a few reasons for this too. Healthcare cost inflation, it's increasing more than twice what regular inflation, so it's continued to be higher. Also, most Medigap policies, they'll end up charging higher premiums for older individuals. And then lastly, out-of-pocket expenses and costs for prescriptions, they naturally just tend to increase as you get older. Okay, so I briefly alluded to long-term care on the last slide. I just want to drill down a little bit more on that due to the fact that 65% of nursing home residents are women. And this increases to 70% in assisted living facilities. This should have been another poll because I don't know if anyone's familiar with what the average cost is in a long-term care facility. Right now, it's over $9,000 per month. That's the US average. So that's over $108,000 per year. So if you're not in a position to self-insure or basically pay these expenses out of pocket from your investments and things like that, another perfect example, you really need to sit down with your advisor to go through this because that can decimate a retirement plan. And I've seen it time and time again. So really important to have those conversations. Okay, so now before we begin to kind of wrap this up here, open it up to Q&A and so on and so forth, let's talk about a much more lighthearted topic, estate planning, everyone's favorite, right? Kidding, no one wants to talk about this stuff, but seriously, if you don't have a valid estate plan in place, this can really throw off your wishes. And I've seen it create a lot of strife among family and friends in the form of probate. Maybe you unintentionally disinherit a family member, or maybe you're not spelling out your end of life wishes. So some important documents I just wanted to hit on here. First and foremost, and both Tina, Chad, and myself, we talk about this ad nauseum. So first and foremost, you want to ensure that all of your beneficiaries are up to date because these accounts pass by what's called operation of contracts. They override any other estate planning document on this slide. So whoever you have listed on those accounts, and we're talking about 401ks, 403bs, 457s, life insurance, and you do through the employer have to set those up individually. That trumps anything else on this slide. So whoever you have listed as the beneficiary, that's where the money's going. Also, do you have a valid will? So a valid will, that will ensure your assets go to whom you intended and not someone else that you did not. You can also, if you have minor children, you can identify a guardian for any minor children. Now moving down, if your situation is a little more complex, a trust might make sense, especially if you happen to own out-of-state property, whether it's a rental property or a retirement property. By not having out-of-state property in a trust, you will be subject to something called ancillary probate. Meaning, if anything happens to you, not only will your estate be probated in your domicile or home state, but also where the actual physical property is located. It doubles up on the probate expenses. It's a public proceeding, it's expensive, and it's a tremendous inconvenience for your beneficiaries and heirs. Now, lastly here, if you were to become incapacitated, do you have a power of attorney for healthcare property? In other words, have you essentially designated someone to become you? So they're making your financial and medical decisions, and this can be split. It's not an all or none thing. So if maybe you have kids, one is very financially strong, you would make them the power of attorney for your assets, and then maybe another child for the medical. So you can split it up. It's not an all or one thing, but it's really important to talk to an attorney about this. Estate planning is not a do-it-yourself project at all. But one thing I wanted to share with you actually is a website that kind of kickstarts this estate planning conversation. It's called 5 Wishes. So this is a great resource. You can go on to 5 Wishes. Maybe Chad, can we drop that in the chat, please? The link. I apologize, I forgot to mention that.
It is there right now,
Okay.
along with a few other links too, by the way, but continue.
Excellent. He's always one step ahead. That's why he's. So the 5 Wishes is a living will. So in the event you become incapacitated, it's end of life decision making. You have all your wishes spelled out before something happens. Doing it after the fact, that's not going to help you out. And then you have family members fighting, saying she would want to be taken care of like this. No, she wouldn't. I've seen very closely knit families just broken apart when something like this happens. So it's as simple as going onto the website, filling out again these thoughtful questions. Once you answer those, you can print it out or you can get it electronically, whatever is best for you. And for $5, you have your living will in place and you do not have to talk to an attorney about any of this. But this is a really important estate planning document and you can get that completed without having to go through the entire estate planning process. Because again, all the other documents on here, those are not do-it-yourself projects. You need to be, whatever state you reside in, you want to look for a probate and estate planning certified attorney. So that's really important.
Guys, can I add to this real quick? So first and foremost, we don't get paid by 5 Wishes. That's not an ad or promotion. We're not sponsored by them. That truly is just like, it's a really great, really cheap resource that is out there. What I can also tell you, if you have a more complex situation, estate planning attorneys love these online resources because it means they make more money, because they don't get things right if you have a very complex situation. So definitely if you have multiple houses, a lot of children, whatever you might have, honestly might make sense to pay a little bit of money and talk to an estate planning attorney and go through that. But 5 Wishes is such an easy place to start if you're relatively young, if you have a very, very simple situation. It doesn't cost a lot, and at least it puts something in place.
Right, that's a great point. And it just again kickstarts that conversation on the bigger and better things when it comes to estate planning. So good point.
Can we do one on beneficiary elections? I know we got a lot of retirement plan participants here too. And what I can tell you,
I was going to mention that, Chad.
Oh, go for it, Tina.
Yeah, I was just going to mention, as it relates to beneficiary designations, a lot of times employees feel when they're going through their benefits and they're listing out beneficiaries for maybe life insurance or their medical, that also applies in the 401k plan. And that is a completely separate structure. So going in and looking at your retirement plans, making sure you've got a beneficiary designation, but also not just with your current employer, with your previous employer as well, making sure that that is up to date and current. We see a lot of situations where it's not updated, life changes, they never updated their 401k, and that is the overriding document. So whatever is listed there is how it's going to be distributed. And Keith, do you want to add to that?
No, I mean,
Okay.
to drill down a little more, working with blended families or couples
Yeah.
that are divorced, sending checks out to the ex-spouse or the account to the ex-spouse is not a desirable outcome. So again, you can list contingent beneficiaries on these as well. For the contingent beneficiaries, if you get divorced, if you have minor children, you should not be listing them on there. And there are some reasons why. And everyone's situation is different here. But just make sure those are up to date. It's simple, it costs you nothing, and it protects you.
Right. I also want to mention that, when you talk about the trust, this really is a very overlooked area. And if I'm being honest, it actually took a global pandemic for me to start a trust. So it's something that a lot of people think about, but never actually, execute on. I was talking to a girlfriend last night who has her partner is 18 years older than her, and she's the sole breadwinner. And I asked her if she had a trust, and she said no. And I was so surprised. She's in our business. So it is a very common thing to overlook, but a very, very important one. So I would certainly look at the website they provided, or just start that process and start thinking about it.
100%. And you control so much in a trust that you can't in a will, because a will is a probatable document. So if it's a valid will, and that's the important piece here, the courts will validate the will, the assets are distributed however you wish. The trust is a private document. So if you're a private person, you don't want to go through the public specter of probate, that might be the route to go as well. It does cost you a little bit, but it pays itself off over and over and over again if anything were to happen. Plus, you're not inconveniencing your beneficiaries and heirs, and that's a big deal. Anything else, Tina, or should I move along here?
No, I think the next one's mine.
It is yours.
We're going to wrap it up. All right. Well, to summarize, we've provided our retirement checklist for you to consider. It's going to help improve your retirement outcomes and take control of your financial life. So the first is to try and pay off any debt. We've seen that women carry higher percentages of debt, and this really can be an obstacle when you're saving for retirement. And once you've paid off your debt, establish an emergency savings that has at least 6 to 12 months of your salary. This will help you be better prepared for unexpected expenses or maybe a disruption in your employment. Next is trying to max out your retirement savings program, or at least contribute up to your employer's matching contributions so that you're not leaving any money on the table. And if you do have access to an HSA, which is a health savings account, you'll want to fund that as well. An HSA can offer triple tax benefit by making pre-tax contributions that grow tax-free, and then the distributions, when used for qualified medical expenses, are tax-free too. So it's a great savings vehicle. Next, focus on what you can control. We've talked about this a lot. Build that diversified portfolio that aligns with your risk tolerance and stay the course. It's really the best strategy for long-term investing. And if you've taken all of these previous steps, you'll be in a much better position to maximize your Social Security benefit by waiting till at least your full retirement age. And it was great to see that the majority of attendees here are planning on waiting until their full retirement age before claiming benefits. And then it is a fact that women do live longer, so plan on funding more years in retirement and incorporating those rising healthcare costs into your retirement plan. And finally, be prepared for the unexpected. So whether you have a family or you're single, you really want to have all your ducks in order. So other people aren't making decisions about your life or your finances. So get those documents in place that we talked about. And that was really it. Keith, do you have anything to add?
No, I think you hit on pretty much everything. Well put, maxing out the retirement savings. When I looked at that, you did mention at a bare minimum, you can't leave that money off the table, take advantage of the employer match for sure. And even starting early, again, you don't know what a positive impact that has on your retirement. And also, I mean, if you're going through your employer plan, can you increase that by 1% year over year and make sure, you know, put it on autopilot, so to speak. You won't feel it coming out of a paycheck. However, that 1% over 15, 20 years working just has such a great impact, positive impact on you. So.
Hey guys, before we move on, I know we don't sell insurance. We don't like to talk about insurance, but Keith, be prepared for the unexpected. Can you talk a little bit about like why people, like what type of insurance people might want to buy?
You're putting me on the spot here, Chad. Is that what you're doing right now?
That's what I do.
I believe so.
He does, yes. No, I'm kidding. So be prepared for the unexpected. You want to try to mitigate the catastrophic losses. There's risk in life every day when you leave the house, whatever the case. But some of the big ones, I mean, obviously, if you're, we talked about who the primary breadwinner is and so on and so forth. If that's the only income coming into the household, you need to protect that. So from that perspective, you should have 8 to 10 times your annual salary in the form of life insurance. And we are in the camp that term life insurance, you can get a lot for not much money. That fits the bill there. Or maybe you have kids going to college or you want to make sure a mortgage is paid for. Term insurance fits the bill there. There's actually, we don't endorse, and this is just another resource to explore. Select Quote, they're the biggest term policy seller in the country. So they'll go on, they'll shop a bunch of different insurance companies for you, but you could get a lot of term insurance for next to nothing. So you're mitigating a lot of risk there. Second one would be, do you have liability coverage? So let's say you're closer to retirement, you have a home that's almost paid for, maybe you have a rental property, whatever the case. Let's say you get into, I'll use this example, you leave the house, you get into a car accident, it's your fault, you're going to be sued. So let's say for this example, you were sued for $400,000 and the liability on your auto is only $300,000. If they win, you're on the hook for that difference, that $100,000, because the insurance company will pay the first $300,000, and above and beyond that, that comes out of your pocket. So I've seen homes that are paid for that have been taken away, brokerage accounts, any non-retirement accounts. And the reason I bring up umbrella coverage is because I think, and I work with folks across the country, you can get $1 million coverage in umbrella for next to nothing, maybe $350, $400 per year. So again, you're mitigating a ton of risk for next to nothing. So if you have your home, your auto through the same insurance company, and this applies to you, reach out and say, okay, can you quote me a $1 million umbrella policy? They'll totally understand what you're talking about. So those are the two biggies there, Chad.
Thank you, sir.
Yeah. I'd also mention when you were talking about the life insurance side of things, I have another girlfriend that just left her job. And again, she's the sole breadwinner, and her life insurance, she had a group life through her work. So when she left her job, she lost that, and she hasn't replaced it. So another thing to kind of think about when you're looking at insurance is it through your employer or do you carry your own?
Yep. But I mean, bottom line here is you don't want to get involved with the very expensive whole life policies or universal life or variable life or any of this. Like I said, in 99.9% of the cases, term will be just fine.
Okay, guys. So next steps here before I get to the questions, right? We did put contact information, right? Toll-free number, email address to reach out to us. If you do have questions that we do not answer today, please reach out. Next week, we have our Finding Your Retirement Mindset webinar. I did in the chat box post a link to a 1 to 2 minute survey. I posted a link to register for next week's webinar if you are not already registered. I also posted a link. I know these guys talked about Medicare, and we don't have any questions about it, which is amazing because we don't want to answer questions on Medicare today, but we do have a link in the chat box if you want to watch the replay of last year's webinar. We had a Medicare expert on the line. He talked all about when to take it, how to take it, why you should take it, all that kind of fun stuff. There's a link to that replay on YouTube in the chat box as well. I also posted the links to 5 Wishes and Select Quote, just in case. So all of you have access to it. Again, there's no referral fee for us. That's just resources I think Keith mentioned that are always really good places to go. The next question I have though, and this is an amazing one, because I actually think I asked Tina to take this slide out of the deck. Is there truth in starting something like an IRA at a young age, right? Maybe 21 or 25 years old, depositing $100 a month, and would that be good enough for retirement?
Well, it would be a phenomenal start. Absolutely. And I think you would not be disappointed if you did something like that. I'm always thrilled to hear someone saying they're interested in starting to save at that early age. You have 40 years of time horizon there where you're continuing to save. That compounding effect will have a dramatic impact to retirement. So while it may not be enough to fund 20, 30 years in retirement, it will certainly be a considerable amount that you would have at that time to certainly give you more options. I don't have a specific number, Chad. I don't know if we've actually run.
There's not. So
what the amount would be.
I think the statistic out there, like Fidelity did a report a couple of years ago that says the average person should save about 15% of their income for their entire career. Right? So that means like somebody that early on maybe saved 3-4%, then you get to 6%. Eventually, you need to save 20% to average that out at 15. But you should, to have a successful retirement, save about 15% total. That's inclusive of both your savings and your employer contribution. So if your employer matches or does a profit share, that does count towards that 15%. But it's like, starting at $100 when you're 21 years old, it's better than nothing. All I can tell you is the compounding money makes money and more money makes more money. The difference in saving, this is the slide I asked Tina to remove. If you started at 20 versus like 30 years old, the difference in your long-term retirement savings is astronomically high. We're talking hundreds of thousands of dollars. And it's not the $100 per month over that 10 years, right? It's the growth of your money because of gains in the market. The compounding over that 10-year period is such a big impact. So the sooner you can start, the better. Start for your children. If you have children, like I'd start saving for them when they're like 1-year-old. Like start an account and start and help them save. That right, the earlier you start, the better.
And also one last thing on that. Starting early, if you think you're going to earn more money in your career, there are a couple different options. You could contribute to a pre-tax IRA and then also a Roth IRA. And I would probably explore the Roth first, because once that money's in there for 5 years and you attain age 59 and a half, everything comes out tax-free. And we don't know what's happening with taxes right now until the year 2025. So a lot of folks that I work with think they're going to be in a lower bracket in retirement. But the reality is, if you take Social Security, maybe you or a partner has a pension, distributions from your retirement plan, hypothetically, you could be in a higher tax bracket in retirement. So that Roth IRA is a hedge against anything like that going on. So I check that out.
Sir.
Yeah.
Okay, group. So the next question we have here, I love it. We got a lot of thumbs up going on. Is if you have a disease like Parkinson's or any other type of disease, when you retire, can you claim disability?
Via Social Security?
I don't know. The question doesn't specify. I feel like you might claim disability insurance instead.
If you have disability insurance coverage. So yeah, that's one of those examples. The definition for disability for Social Security is incredibly strict. And I know folks that actually have to, go to court proceedings and If they define it as such, then yes, obviously you would be able to get a disability benefit, and that changes everything because that's separate from a retirement benefit. I think that's where the attendee was going with this, but I'm not 100% sure. That's a great example of reaching out to us. That's why we're here. We're a resource for you.
Yep. Thank you, sir.
Yeah.
So the next question I have for you is, so what happens if you have both a trust and a will? Is there a conflicting direction? Like, does the trust trump the will, or vice versa? Like, should you have one or the other? Like, what, any guidance?
Well, generally speaking, if you go into an attorney and they're setting up a trust for you, they'll also set up something called a pour over will, which is pretty much automatic if you're paying their fee. So what that means is, let's say down the road, you buy a property or acquire an asset that you inadvertently did not put into the trust. When everything is probated, that pour over will capture those assets to make sure you're safe. So a good attorney has all of it. It's all encompassing. So they work together, so to speak.
I like it.
Keith, one of the things you want to think about when you do set up a trust is that when you have assets, you want them to be registered within the trust. That's what helps protect those assets.
That's exactly right. And it's a little bit of a headache, but again, the planning involved is going to just pay itself off over and over again. So it's not fun. I mean, Tina, you said you recently went through it, but it's also important. Now, do you think you could have done that on your own without the assistance of an attorney?
I don't know. I went through an attorney, and I was glad I did. And I've since relocated to another state, and so I had to have it amended. So I think you have to also think about, if you have changes, it's helpful to just know that you can go to someone and make sure that it gets done properly.
That's exactly right. Yeah, if we're not an expert in something, we wear all these hats. We wear the attorney hat, CPA hat, financial planner hat through the CFP designation, but always defer to the professionals. That's all they do. And it's your best interest that'll come first.
You guys have accidentally set up the next question so perfectly. So the next question I have for you is, so get a will if you don't own a property, is what we've heard. And a trust is more appropriate if you do own property. So the first part of this question, is that correct? Secondary to that question is, do you need to have a trust prepared by an attorney? My employer offers free trust services through a third party. Like, would that be effective?
I 100% would start there first.
Yeah.
And then if you don't have a good experience, then you want to shop 2-3 attorneys, depending on where you are. We do have referrals, again, no financial compensation to connect you with an attorney, but this group's all over the country. So the trust start at the employer. In regards to the will, so there are 2 different things going on here, Chad. The attendee mentioned, okay, if I don't own property, are we referring to the living will? That's what I want to make sure I'm not confusing here. Because if you own no property, maybe you have an employer-sponsored plan, you're renting right now. The 2 most important documents to have, number 1, keeping the beneficiaries up to date, for sure, for your retirement plan. And then in the event you become incapacitated, the living will, that's what you can get through 5 wishes. So if you have no property to actually transfer, then I could argue, but I'm not an attorney, I could argue that you don't even need a will if you only have a retirement plan, right?
I'd agree. 5 wishes, no matter what.
Right.
And you probably don't need a trust. You don't need a complicated estate plan, right? Like, if all you have is a home and a 401k plan, you need 5 wishes, and that's probably it. So next question I got for you guys is, and this one I might say this probably reach out to us and we can give you resources, but where can I learn more about an HSA?
Well, I think the first thing would be to actually ask your employer if there's one available, but it has everything to do with your medical plan that you're on. You can only qualify or invest in HSA if you have a high deductible medical plan.
Yep.
So if that's the case through your employer, then you have the ability to access that HSA, but it's not something that everyone technically has access to.
Great point.
So next question I got for you too is, if your home is in a trust, can you be sued and still lose your home?
Yes. So unless it's there are two different types of trusts. There's a revocable living trust. So as the name suggests, revocable, it can be revoked or changed. So that's part of your estate. If you get sued, that home would not be protected. In rare instances, I do work with some participants and clients. They do have their house in a irrevocable trust. That would be creditor protected. But if it's in a traditional, revocable living trust, it would not be protected. That's an extension of you, basically, that trust.
So the next question I have for you too is, what's the best source to get an umbrella policy?
I'm starting with whoever you have your home and auto through.
Right.
This is pretty interesting because a lot of people that I work with don't have the umbrella, even though they need a policy like that. And I'm shopping around for insurance, the auto went up or whatever the case. I've worked with people that actually left their current insurance company to go wherever they go, and bundling all up between umbrella, home and auto ended up being less expensive. So it doesn't hurt to shop around, but I would always start with whoever your primary insurer is on the home and auto.
Excellent. So next question is, what is the best way to estimate how much in retirement savings someone might need or want to have?
Tina, this has you written on.
Yeah, we had it. We should have had that chart in there. There's kind of rules of thumb. And I think it really depends on what you want to do in retirement. There's so many different ways to go. Some people want to work part-time, consult, maybe volunteer, take extravagant vacations. So I really think it depends on what the retirement looks like to kind of figure out what that estimate might be. There are rules of thumb. Let me see if I can find a quick chart that we can put up while we're answering questions.
Yeah, when you're looking for that, there's something, the 80% rule. Many of you may have heard on this call, so you'll need about 80% of your pre-retirement income in order to maintain your standard of living throughout retirement. So it's basically calculating, okay, I'm going to spend, $50,000 in retirement. Social Security will provide for this much. And then the remainder of that would be on you to figure out. But like Tina said, everyone's situation is different. We do this stuff every day, helping budget and plan for retirement. So we can always help out.
And, we hadn't really talked about Social Security earlier, but on average, it's really meant to replace about 40% of your pre-retirement income. And that's a very broad average. But when you think about, you're right, you do want to think about what you're currently making, what you also want to replace, what kind of income you want to have replaced in retirement. I will find this presentation though.
And one thing we didn't mention too about Social Security, benefits, they used to be tax-free. So in an effort to try to save Social Security, they started taxing half of everyone's benefits. And then 10 years later, they did that again. So everyone on this call can plan for approximately 85% of your Social Security benefit being taxed as ordinary income. So that probably just opened up a whole nother can of worms. Okay?
It might have. So while we're on Social Security, I do have a question on that. Does Social Security have a maximum payout? So what I mean by that in the question is, if we've already worked the max, right, is it truly worth working longer if you're making more to increase your payout, or is there a maximum amount that Social Security will pay out, period?
There is a maximum amount, and Tina, I don't have that up, but it's in the $4,200 per month range or somewhere around there. That's a moving target. It changes every year, and they're really talking about the way the system's set up right now, there will be some changes going forward just to sustain everything. Nobody knows what that looks like right now, but if you're maxing out your benefit, there's no additional kicker or benefit to waiting, I guess, if that makes sense.
Yeah, I mean, what I can add to that is I did put in the chat box too, ssa.gov. If you go to Social Security Administration website, you
That's
can always see what your benefit like would be. Like they will estimate your benefit for you. But yeah, there is a max. It's a little over $4,000 a month. But again, you need to make pretty substantial earnings to get that max too. So I think depending on what you earn throughout your career, that's a it depends type of question.
Yeah, but that's a
next-
great point to actually go set up your account and really start understanding what that benefit's going to be, especially as you're getting closer to retirement.
Yep.
Because
Okay, next question for
Definitely
you
varies.
guys, for you two. I have good opinions on this one too, is do you recommend paying off debt and establishing an emergency fund before investing in your 401k or do so at the same time?
That's a balance there, Chad. You can chime in on this one, but I'm in the camp that emergency fund, that's kind of like your core or your foundation. Again, if you're gainfully employed, you're younger, even 3 to 6 months living expenses set up in just an interest-bearing account. It doesn't matter what it's doing right now because rates are super low. But to have that in the event you have an unexpected expense, that's key. That's your safety right there. And the debt, if it's a 20%, interest rate on a credit card or whatever the case, I'm looking to pay that down first because the plans that I do that have the revolving credit, the high interest credit, that really erodes the overall retirement plan. So even if you're younger, mid-career, whatever the case, I'm going, emergency fund, paying down the credit card debt. And then if you're able to, and your employer matches, at least do that into the retirement plan.
yeah, I would agree.
I think the context I would add there is, I mean, first and foremost, no matter what, contribute and get your employer match. Like it's free money. It's like pay off debt, all that other stuff. No, at least contribute and maximize your match to get the money from your employer match. The other question, I think the order Keith gave mathematically always makes sense, right? Yeah, of course you want to establish your emergency savings to protect your life, pay off your debt, right? 20% interest, you probably aren't going to make 20% in the stock market, right? Every single year, right? So mathematically, it makes sense. Yeah, I think the one thing I've seen a lot of people fail though is, people like credit cards, as soon as they pay them down to zero, it's like, well, let me go on a vacation and put $3,000 or $4,000 on my credit card again. And it's like, there's this it's a perpetual credit card balance that they're always trying to pay off, which means they never save in their 401k. And so I think you just got to know yourself. If that's you, if the moment you have no debt, you immediately go rack up more debt because you go on vacations and recognize that, then you'll never save for your retirement. So understand that and save for retirement at the exact same time. If that's not you, if you are the type of person that will pay off every credit card, maybe put them in a cup in ice in your freezer. So if you ever want to spend money on your credit card, you have to wait for it to thaw out first. If that's you, pay off your credit cards first.
Can't you get like a sledgehammer though and just break the ice or not?
Well, and something to really think about that a lot of folks don't do is actually starting with a budget, really understanding what you can. I think, was it Warren Buffett that said, don't save what you have after you've spent, spend what you have after you save. So think through making sure that you're putting enough money either away or, not overspending. Those are just good habits to have. For the long term.
100%. The saving for retirement component, just as Tina said, should be viewed as a fixed expense. So that's 100%.
Pay yourself first.
Pay yourself first.
So next question I have for you guys is, what happens to my 401k once I decide to retire? Like, do I need to roll it over to an IRA?
No, you don't. There's some options. You can keep it in your plan. If your plan allows for installment payments or systematic payments, you can start drawing down. You could roll it into an IRA if it makes sense. If you're looking for some other different types of investments. But you do have the option. You can keep it in the plan or roll it out. And I think that's, when you're thinking through that process, really understand, it helps to talk through it with an advisor or a planner, because you really want to understand how you want to utilize that money, because there can be hierarchies. If you've got Roth contributions, pre-tax contributions, it can make sense to take certain buckets of money out first. So that, there's a strategy around that.
I mean, the short answer is no, you don't ever have to take it out of your 401k. You can always leave it with your employer. And you want to work with a trusted advisor to figure out, what's the difference in fees and schedules and investments? Are you managing it yourself? Right? If you move it out, there's a lot of things to consider, but the short answer is no, you do not ever have to take it out of your 401k. The next question I have for you too is, at what point should I consider a power of attorney? I think I'm still in good medical condition, right? And does my power of attorney specify that it's only in case if I'm out of my mind, or what if I'm in the right mind? At what point does power of attorney really make sense?
Tina, do you want to talk durable power of attorney, springing into action, or?
Yeah, I think I'm actually going to defer this one to you, because in my, I think that, yeah, I think you can set up a power of attorney, and then when certain circumstances occur, it becomes effective. So it's certainly something that, I think is protective. But I don't quite, Keith, go into kind of some of the details on that.
Yeah, and I think we had a slide in there, so that's actually a really great question. We're getting into the weeds a little bit, but you can set up something called a springing power of attorney. So in the event something happens to you, okay, that's when it kicks in, and whoever you've selected to make decisions on your behalf, that's what will happen. There's also a durable power of attorney, and you can view this as that person is you. They can make all the decisions for you. So if you want more limited oversight, maybe a springing power of attorney might make sense. And there's no age restriction. I mean, let's say someone who's single, and you're living on your own, something happens, you can't make your own medical decisions. You don't want the family going back and forth on that. So there's never, if you're an adult, there's never an age restriction to set something up like that.
So next question I have for you too is, so I am 63. I know I have not saved enough for retirement. What ways can I maybe fix that over the next 10 years?
Well, I don't know if you're still working, but you may consider continuing to work during those years so that you can continue to save as well. And Keith, I'm going to roll this one to you, because some things to consider: you are technically eligible to start claiming Social Security, but if you are still working, your benefits can be reduced, and they can also be taxed depending on how much you make. So that's another consideration. But I think at this point, being able to, continue to work as long as you can would certainly help close that gap.
Or again, Tina, you mentioned this, going back to the spending and the budgeting piece, that's huge. So tracking your spending for 30 days, writing down where everything goes. This is back in the day, we would, want folks to, okay, put the credit cards away for a while, pay cash for everything. And what does that look like? Where is your money going out the door? Because when we get into the credit cards and things like that, and I don't recall the specific stat, but it is, we spend like 20-25% more on average than paying cash for something. So it's all about tracking that spending, or to Tina's point, working longer. Is there longevity? What are you saving? So those are all examples of things we can definitely get.
Group. So the next one, which is along the same vein, is just due to unforeseen circumstances, I had to deplete my 401k and have restarted my 401k contributions this past year. But I'm in my mid 50s And what should my strategy be now that it's not really long-term, quote unquote, like when I started in my 20s?
Well, you still have a long time horizon. If you continue to be working for the next 10 years, that, that's certainly enough time to, continue to save. But, we're kind of going back to the same thing, now that the time frame has shortened, trying to get more money now invested and saved is going to be more imperative. So it's, you still have time horizon, you still have some time in front of you, but doing the best you can to put more away will certainly help. Definitely taking advantage of the 401k plan or retirement plan and getting your employer's matching contribution certainly can help as well. But I think this is going to be a kind of a budgeting exercise as well.
The closest you can get to that $30,000 catch up, like pre-tax, like savings plus catch up, the better at this point, right? Over 10 years, that's like $300,000 of your own money going in, not to mention market growth over that same period, which is still have a pretty profound compounding effect.
Yeah, but on that note, right there, because I do meet with people that, okay, in your situation specifically, and they want to get overly aggressive outside of their risk tolerance for investing. That's unfortunately not the time to do that. It's about building that portfolio, because you don't want to make rash decisions and sell on emotion and things like that. So that's really key in all of this, because I get that question all the time.
Yeah, that's a good point.
Yeah, I think the big takeaway is don't go 100% stocks because it might grow really fast. Is still recognize your risk tolerance, understand your own personal behavior to make sure that you're able to stay the course.
Yep.
Okay, next question I have for you too is what is considered a safe amount to have for retirement to be financially stable, assuming no major health issues? Like, is it $1.5 or $2 million? Like, we can already predicate this with it depends. Like, if you live in California, maybe $10 million. If you live in Texas, maybe 100,000. No, I'm just kidding. Go for it.
Yeah, it's tough to actually come up with a specific number. And, I think the other thing is whether you don't have health issues or not, that's great, but also still really understanding what that retirement looks like. There's, again, a lot of different ways we can go. So that's really going to depend. And the other part of it, we didn't really talk about in the estate planning is if you want to have a legacy, if you do plan on maybe passing down assets to your family, to your children, that can be another component. So there's a lot of things that go into that, figuring out what that number should be for you. So I don't have a straight answer for you.
That's a tough one too. And I have read some studies. So if you're healthy, you have longevity in your family, that's great. But at the rate that expenses for medical and healthcare are going up, if you're living longer, you're going to be spending a lot more too at the same time. So those are all important considerations, but good question.
Cool. So the next one I have for you too is what are the considerations you need to handle if you plan to retire in another country?
Yeah, Keith, I don't have any insight on that one.
So depending on the country, there are certain reciprocity agreements with the US, but I can tell you this, whether it's an inheritance or your own 401k plan, anything that you own, you're entitled to that. But the tax implications, depending on the country, those are going to vary from country to country. So there's a little more to unpack and a little more detail we would need to know. But anything you saved here is yours, whether you're a non-resident now or not.
So next question I have for you, and this goes back to Keith, hopefully you know the answer to this, is with 5 wishes, does it need to be notarized?
It does.
It does. Answer yes. Next question I have for you is if one has an HSA and then applies for Medicare, how do you handle the funds in the HSA? Can they be transferred to another vehicle? Would it be a taxable transaction? Like, what do you do with that HSA?
you can still use the funds, you just can't contribute to the HSA at that point when you're Medicare eligible.
I think something we learned last week, because I know last week Social Security presentation is no longer available due to restrictions, but when you're ready to apply for Social Security, do not contribute to your HSA for at least 6 months before you start to apply for Medicare. Right, that was a rule we learned, that you can be penalized if you do so. Like, so when you're getting ready to age 65, apply for Medicare, stop contributing to HSA about 6 months in advance of that.
That's good to know. 6 months. Okay, that's good. Yeah.
So next question I have for you is, I left the job after 20 years, about 7 years ago. I left my 401k with a previous employer. I don't really keep tabs on how it's doing, but any idea what I should do with it?
Yeah, there's a couple of options there. One of the easier things to do is actually take that plan and roll it into your current 401k plan. Depending on, I guess it's depending on where that plan is. I have a previous employer plan that's with an insurance company, and they actually have a fixed account that's paying a really high rate. So I keep it there. So you can keep it there. You can roll it into your current plan. If you're over age 59 and a half, you can, if they allow in-service withdrawals, you could put it into an IRA. So there's a few different options you have, but typically, I know, Keith usually tends to prefer to have the retirement accounts consolidated. It's easier to manage and making sure that you have the right risk profile. And then especially when you're ready to start taking distributions, it's all in one place. Keith, anything to add there?
Well, I was going to say, and I do this on a daily basis. If you're looking, we can analyze the portfolio. I mean, if it's a large plan with really low costs, great investment options, maybe you have a fiduciary consultant overseeing everything. Well, then maybe it makes sense. This year, for someone taking required minimum distributions, that age is going up to 73, eventually to age 75. So you really don't have to touch it until then. But if you have another plan over here, you have an IRA over here, then it gets messy. So, but if you want a review of the portfolio, things like that, we have the resources to look at it. And if it makes sense to keep it there, we'll tell you that. And if it doesn't, then we can explore some of the options Tina was talking about.
Well, thanks, you too. Next question I have for you is, I've started a 401k, but how do I know if I'm invested in the market? Do I have to do anything, or is it automatic? I love this question, by the way.
Yeah. Well, it may be automatic. If you enrolled in your 401k and started investing and didn't make any investment election, 401k plans have what's called a default fund. And that basically means that if someone doesn't make any election, it goes automatically into a fund, and it could be a balanced fund. It could be a target date fund that already has an asset allocation design based on when you're going to retire. So it could be automatic based on your plan. Best thing to do is either log into the website or call the current plan administrator that you have and find out how your investments are allocated. But it would be something that you should definitely be checking on a regular basis to make sure that you're in the right allocation.
Okay, so the next one I have for you guys, I'm actually jumping a couple down because there's a misconception here. Under our employer plan, we are able to contribute to both a 401k and a Roth IRA. Or would you rather do one or the other, or inside or outside of the plan? So first, let me correct that misconception. Is in your 401k, you have a pre-tax and a Roth option. There is no employer Roth IRA inside of that specific plan, right? You can contribute to your 401k in a pre-tax or Roth, well, money source or bucket, but it is still one balance in your 401k plan, which is completely separate than saving in a pre-tax IRA or a Roth IRA that you can establish at any bank, any company, Schwab, Fidelity, JP Morgan, wherever it might be. They are separate options, right? So now I think the bigger question is do you guys recommend having one or both? Pre-tax or 401k IRA, like what do you recommend people doing with their money?
Yeah, and I think the way I'm reading this is also, if they have a 401k plan with their employer, can they also contribute to either a Roth or regular IRA outside of the plan? And the answer is yes, you can, but there are some limits. There's certainly some income limits when it comes to Roth. And then there's also limits on the deductibility if you were contributing to a traditional IRA. So there might be some limitations, but you can have both of those types of accounts established.
The limits are independent of one another for the Roth IRA and the 401. But to Tina's point, there are income restrictions to contribute to the Roth IRA. If you are someone who falls under those income limits and you're looking to build your Roth bucket, you want to get that started within 5 years or so before you go to retire, because then it starts that Roth IRA clock ticking. So if you're retiring in 5 years and you're attaining age 59 and a half, at that point, everything can come out tax-free. So that's kind of the 2 cents there. But I mean, I still like Roth because of the uncertainty with taxes and things like that.
So the next question is, I am expecting a large settlement. Should I use it to pay off debt or save it?
Well, that's another tough one too. It's because, we're kind of looking at that in a vacuum versus, what the overall picture is. Depending on what your current savings picture is, versus what you currently have in debt. Is it high interest type of debt? Is it student debt? I would say we'd probably want to take a closer look at that. But overall, generally, we typically want debt to be paid down and then start. But you also have to make sure that we've talked about this before, that once you pay it down, that it doesn't come creeping back and then you end up accumulating debt later on. So those really have to kind of go hand in hand, that once you pay it off, that now you can actually start saving more, taking the money you were using to pay down your debt and now putting it away and using that for your savings.
I give the mathematical answer is, if your debt is more than 6 or 7% interest rate, you should pay it off, because nobody expects the market to make more than that over the next 10 to 20 years. If your debt is sub 3%, like a mortgage that you refinanced 3 or 4 years ago, it's almost like free money. The hard thing I have is that there is something just called peace of mind too, right? I know a lot of people that, mathematically does not make sense to pay off your mortgage, because if you're paying less than 3%, you're probably going to make more on your investments. Like, why not pay off your mortgage with the earnings on your investments if you can make 6%? But there is this peace of mind, just not having debt, right? My own wife is one of them. Like, she'd rather not owe money to anybody. Like, why are we paying the bank for anything, even if it's only 3%? And she'd rather get rid of all of our debt, right? And this is the idea of, let's get into retirement, and no matter what, our house is our house, our roof is our roof. We're never worried about certain things, and investing is always uncertainty, right? So just understand yourself. Peace of mind is peace of mind. But the mathematical answer is pay off high interest debt, right? And continue to hold low interest debt and pay it off with your earnings. Next question is, studies show that women tend to be more risk-averse investors. How can women strike a balance between risk and return when making investment decisions?
That's a good question. Well, they do tend to, but as I'd mentioned earlier, a lot of the studies are showing that even though they're risk-averse, because they're staying invested, they're not really impairing their overall returns. So I think really understanding what your risk profile is and making sure that you're in that appropriate asset allocation mix is going to help, because it's going to allow you to stay invested. So I would say, the first thing is really understanding what your risk tolerance is, and then building that diversified portfolio, and then obviously staying invested. So the key to this is, going through these big market dips, and we've experienced several of them, over the last few decades. Those that stayed the course ended up really benefiting. And those that jumped ship and tried to get back in later on, it really impaired their overall goals. So finding something that's going to allow you to stay the course is really going to be the key.
So the next question I have for you is back to HSAs. Do you have to have a high deductible medical plan to qualify to contribute to an HSA?
Yes, you do. You have to have, yeah, that they go hand in hand. So an HSA is available if you're using a high deductible medical plan.
And so the next question is on the topic of Roth, what is the threshold income wise that you can make annually and still qualify, contribute to a standard Roth versus other type of account? I do have the numbers pulled up just in case.
Yeah, oh, go ahead.
In a 401k, there's no income. You can make $20 million and still contribute Roth inside of your 401k, 403b, or 457 account. There is no income limit, period. There's this misconception out there that Roth IRAs and even traditional IRAs have an income limit, which is around, for those like single people out there, around $150,000. Married, finally, jointly, it's closer to like $230,000, where you can no longer contribute to a Roth IRA or a Roth individual retirement account, right? But an IRA has income limits of or savings limits of $6,500 or $7,500 if you're over age 50 with those quote unquote catch up. Inside of your 401k plan, again, no matter what, no matter how much you make, you can make $20,000 or $20 million. You can always save to your Roth 401k plan, right? And that is, again, the limits there for 2023 are $22,500 or $30,000 if you're over age 50, either pre-tax or Roth in your 401k, 403b, or 457 plan. Anything else to add to that, you two?
No, those are the rules. Yeah.
That's it. Those are the limits.
Okay, so next question I have for you is if you need long-term care and exhaust all of your savings and have your assets in a trust and have to go on Medicaid, are your trust assets protected?
Not if it's in a revocable living trust. No, and most likely that would be the case because when we get into the irrevocable living trust, that's when property is removed from your estate. And even then, there's a Medicare look back where they go and say, okay, you were trying to get all this out of your estate and it doesn't work like that because they'll find it in order to qualify for Medicaid. But if you've had an irrevocable living trust set up for a long time, that's not part of your estate. So that would not count towards Medicare, but most likely it's a revocable living trust, which is part of your estate.
So next question I have for you too. If you have money in an inheritance IRA, would you leave it or withdraw it and invest it somewhere else?
It depends. Is it a non-spousal or spousal inherited IRA? There are so many moving parts. You have different withdrawal strategies. So someone who is a non-spousal beneficiary, you have to get that out in a certain number of years.
Right.
So there's strategy there. And how much do you take out each year? I don't know how it's invested. Now, if we were talking a taxable account where there could be implications and positive ones from a tax perspective, but the whole thing with the inherited IRA, anything coming out of that is ordinary income. So again, more questions right now than answers, but I don't want to give you a bad answer.
So more on the inheritance though. If I inherit $200,000, how much of that should I invest after paying down my debt?
Well, once you satisfy your 3 to 6 months living expenses with whatever's remaining, then I'm comfortable with building a diversified portfolio based on your risk tolerance for the long term.
So next question is, just curious if we're all debt free. Are all of you set for life? Do you practice what you preach? This is just a fun one, guys.
I do not have credit card debt, but I do have mortgages. So I wouldn't say that I am set for life. More to come, but certainly do try and follow these principles because we know that they, certainly can lead to long-term success.
Yep.
I tell you similar. I got a lot of white hair, but I still have well over 20 years before I retire. Do not carry a lot of credit card debt. My wife still has student loan debt, right? It's low interest. And like we talked about earlier, right? We balance, have how much to save, how much to invest, and how quickly to pay off debt. We have a mortgage, right? We have all these things that are going on in our life. And so we try to max out our 401k plans, right, at the maximum limits and balance like how much to pay off for student loan debt at the exact same time. I was the one like right out of college, I like ate mac and cheese and ramen noodles so I could pay off my student loans immediately. Only to come into an industry and find out I was only paying 5%. I probably shouldn't have, right? I could have invested instead of paying off that debt, and it might have been mentally smarter. But for me, I like I said, peace of mind. I didn't want student loans. I hate this idea of having debt out there. So yeah, we try to practice what we preach. But yeah, honestly, not debt free. I still have a mortgage, and I will have a mortgage forever. Sub 3%. I feel like is free money for me.
Yeah, 100%. And I have less gray hair than Chad, but I'm a lot older. And yeah, I knew without the student loan debt, I graduated with student loans and those are paid. And in traveling for many years for work, put everything on an American Express card and pay that off every single month. That's kind of the golden rule when it comes to the credit cards, is paying those off each and every month. And then lastly, in regards to the mortgage, that's technically considered good debt and the home appreciates. There's nothing wrong with that whatsoever. But yes, we're buying into what we're talking about today.
Awesome, guys. So the last question we have really is not so much a question. It gets to our webinars and our content, and we recognize a lot of what we say is terminology that we hope all of you already know. And will we ever have a more basic webinar? I think the answer to that is yes, 100%. Please do. In the chat box, you have a link to a 1 to 2 minute survey. Everything that we produce, this entire summer webinar series, our fall webinar series, when markets are going crazy, we had a winter webinar series just to have good content for all of our clients and their employees and their participants, is basically built on these surveys, right? Is we want to present what you want to hear. So do fill out that survey and tell us. We can do investing 101, we can do ultra basic investing, retirement plans. We have a series in the past on just saving and budgeting we did. They are available on our YouTube channel, BFSG University, where you have just savings and budgeting, for example. So yeah, please do fill out the survey. Let us know what you'd like to hear in the future. It's intriguing to get that question here in a Q&A, because I don't usually publicize the fact that this is all a survey. But again, we are trying to bring content to our audience that's based on what you've asked us for. So please let us know your thoughts. So keep in